What's up, what's up, what's up? Going on, everyone? Hope everyone is well. This fine day. So starting off here, you can see we had the daily gaps from yesterday. Those gaps stayed open. You know what that means? Our bias is shifting. Bias shifts into the potential for longer term bearish order flow. This is on Euro. We also have a couple of points of demand to mark up. A couple of points of liquidity. I also want to clear up a lot of the smush in here because there's a lot of mess in here. But our bias now has changed to bearish. We have the bearish bias here on Euro. And that's the same with GU. We also have a bearish bias on GU. So the targets open back up for the lower time frames now. I'm going to clear up all this stuff here. Change the visibility. What's going on, Andre? Hope you're well. Okay, so I actually have a new template for this just to keep it a lot cleaner. Target template. It's an X with simple line, so you can see where we're looking at targeting rather than. We can also get rid of this because that daily gap is open. We can see that it's an open gap now. Okay, so down to the 4 hour to mark some liquidity. Here and here. Again, these are way off, so probability of sweeping these is low. But we have to keep in mind that there's potential there. I'm just going to put this and this. Just change the visibility on that to, yeah, perfect. Here and here. Change these to LGT. These would be, get some gold. I want it as this. So save this template as entry zone. Cool. I'm actually going to clean up some of these entries as well. Get rid of swing high plus, get rid of all this stuff. Keep SPs, SL1 and SL2. Sell side origin, buy side origin. Get rid of that. Liquid high, liquid low. We'll keep those. Okay, so we didn't actually have a sweep of this. When we come down lower, you can see that this candle, you look up the top here, when you highlight this candle, it says the low is 6491. And then if we highlight this, you'll see the low of that is 6489. So it didn't quite sweep that low. At the moment, we're still looking for another push down potentially here. So another run into this lower area. And from there, we could start to see price targeting these highs. Remembering that the daily here is still overall long. We spent yesterday sort of chopping around. We didn't really see a huge amount of movement on gold. There, of course, was lower time frame moves that could be taken, but mainly it was just chop, very, very chop. So Tuesday, as you can see here, Wednesday, had some nice sell-off moves in the early hours. Then we just chopped around during London, swept out the highs, swept out the lows, then come back to the highs, and then we stayed within that sell range since. So there has been a fair amount of movement, but it hasn't been any trending move. We know that most of the time the markets don't spend their time trending. It's predominantly a consolidation basis, which is fine, and why we always target the relevant points of liquidity, rather than trying to focus on price action giving you a consistent moving market, when realistically it's probably not going to give you a consistent moving market 95% of the time. Okay, so on this time frame here, it's the 15-minute on euro. So daily, we're bearish. We want this price action to come down lower. So it means we're going to start looking for price action to come back into the highs. So what I'm going to do quickly is we're just going to clean up a lot of this, like here, because we don't need to see half of the stuff on here. Where's the settings for that? Okay. Don't know why that's gone weird. Right, okay. Not sure why that's doing that. Visibility, yeah, visibility daily. There we go. Perfect. And then we want all the stuff in here. Don't want to see it. We don't need that labeled anymore. That was for an example purpose. We can get rid of this, get rid of this. If we need those, we can just re-highlight them. Really not a problem. And again, get rid of it on the daily. So now you can see that we have a sweep of the high. We have 2 high points right up here. We're not going to actually highlight those because at the moment we're looking for targets, not looking for not looking to places to trade from, because we're on the daily. We're looking for places to target. So target 1 is going to be here. Now, why is it going to be there? Well, it's actually the closest pre-established high, or low in this case. This is the low right here, so we're going to mark this as target. Okay, so this is our target on the daily time frame. So based off of this principle, we know that lower time frame has come in, bullish, 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 then it's broken down substantially. We've created a bearish space. This tells us potentially we could see a longer term bearishness coming in. Now, based off of the same principle here, if we have this longer term bearishness playing out, we're going to look for the reaccumulation of orders to deliver us down to that point. And how are we doing this? Well, this is how we're beginning to go down to lower time frame, establishing lower time frame points of liquid, points of price to target, and then we can trade within the smaller parameters within here, while ultimately having a target of here. But what we don't want to do is trade with the mindset that every entry we get to is going to take us down to this point, because that's simply not the case. A lot of the time, the entries we take will be relatively confined. I need this to be smaller. Relatively confined within this sort of smaller area. So let's say we pull back and then we trade lower. We may be able to trade from here to here. Then price may take us out, chop around, then go down to the low. There are going to be instances where this isn't the case and price action does actually continue lower for longer periods of time. But we shouldn't expect it to happen every time. Every time we get into the market, it's a totally different scenario. So don't, every time you get into a trade, expect it to hit your longer term target. We know if we start hitting short term targets, we could potentially see a low being taken on the higher time frame. But until then, we're just going to keep following the short bias, if you were. So I'm going to come down to the 4 hour now. And on the 4 hour, we can begin to mark areas that price could sweep out or target where slightly larger time frame stops are placed. So it's very easy. You're just going to highlight your nearest high that has established a low, which is this. See right here. So that's going to become a target. Now, the reason for that is because if price decides to pull back to here and then sweeps these highs and we see some sort of breakdown within here, that can then encourage us to short the market from this point whilst targeting levels that are established on the way up to there. Worst case scenario is it goes higher. This is something that you always have to think about. Is worst cases, what does it do? Well, it completely blows your bias out of the water, and any trade you get into, you lose. Okay, on to the next one. It's a problematic thing for a lot of people that establishing a bias and that bias being wrong then affects their whole mentality going into the rest of the week or any other trades that they take. The main principle is not every trade you take is going to work, and this is the reality of trading. So don't expect every time you get into a trade it just to run into money. It's not how it works. Like I said, people will tell you that is how it works and you can make 100% hit rate and stuff like that. You can, of course, but don't expect the returns to be crazy. You can have a 100% hit rate for maybe 60% of the time if you're running a very low risk to reward. Or you can take different routes around it. So, for example, if you review almost any of the trades that we've taken over the last few periods, for example, like these trades, okay, you could establish this entry, take it at a 1-to-1, 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 okay? And then that way you've literally hit TP, 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 and miss. So that's overall 75% hit rate across 4 trades. That's great, but the RR is not there. Generally, there is a mathematical way you can work this out, and I will share this information with you. The higher the hit rate, the lower the higher the hit rate, the lower the risk reward, and the higher the risk reward, the lower the hit rate. That's generally just the way it goes mathematically. You can't fake numbers at the end of the day. Numbers are always going to be the true tell of anything. So it's not a case of being correct 100% of the time. It's a case of understanding the probability basis on a real world, like real world scenarios. This is why institutes and big banks and things, they don't use stop losses, they just use margins. So they use a low margin to inherently reduce the risk of potential market movements going against them. But most of the time, or let's say 75 to 85% of the time, they're able to come out of that position in profit because they're not exiting at the point of them losing money, because they don't lose money until that trade's closed. So they will happily take a period of down on their positions to know that ultimately they're going to come out on top. Whereas with stop losses, like a lot of traders use, like myself and many others, you inherently restrict the amount of risk that you can apply to any position. So within the same principle, if we go back down to the 15-minute, like here, if we were an institute operating in a way that works off of an averaging principle or something along those lines, we ultimately would have bought here without a stop loss, seen this position go into negative, we would have bought here. We then maybe would have seen some profit, prices come back down a little bit, we would have bought again. Price comes above and you get out of all 3 positions with a relatively good reward on all 3. You do the same thing. Maybe you buy again, it goes negative, you buy again here. You leverage that position enough so that this position ultimately is eliminated by the profit. Therefore, you've just taken within here 2 very successful trades split across 5 positions when you were wrong completely in your directional bias every single time you traded. But it allows them to leverage their wrong decisions. So it's not something that you should ultimately believe that every single trade you get into works, because even the institute is wrong with their trade decisions, but they're just correct in the way that they manage their liquidity. This is why they are risk managers rather than traders. You know, they work off of a money management basis rather than a being correct in the market every time basis. They also look at you know, a lot higher time frames in terms of positional accumulation. You know, it's not it's done through an averaging cost. So if you can enter below average with a buy, even if the market goes down, probability tells you that it will average back out at some stage and these positions will go back into profit. Now, of course, there can be catastrophic fundamental effects that can liquidate these institutes, but most of the time they're either going to hedge their positions if that's the case, or they're going to manage their risk to a point where they can get out with a small loss and just accept that. That's not possible with a stop loss because you set a hard cap on the loss that you take. So just whenever you're taking positions and you're looking at what the market's most likely going to do, if it goes against you, just accept that. You know, you're really making things a lot more refined and a lot harder, if you were, by applying a solid stop loss. Now, I'm not saying don't have a stop loss, because that's, you know, crazy, especially when it comes to retail trading. Retail traders have to have a hard cut on their loss, because ultimately you would blow your account, you know, very, very quickly. But when you're dealing with huge pools of liquidity, it's something that you can do. So don't think to yourself, oh, you know, how are these hedge funds able to do it, and they're always correct and stuff like that. But they're working on a totally different basis. That's why putting your money into, for example, like an investment fund, something like that, is generally going to be easier for 95% of people, because you don't have to do anything. They do all the hard work for you. Now, with this pair, go back to the daily time frame. Just going to get rid of these. Go back to the daily time frame, and you can start to see that we have one target low. This is ultimately what we're looking for. So if price action moves from where it is now, which I don't believe it will, we could see this, but I don't believe it will. This will give us a 37 pip movement to our target. Okay, so it's not a huge movement. When we come down to the daily time frame, the hourly time frame and the 4 hour, you can still see the target and you can still see points that we're looking at. So it gives us the scenario of price running up to this target, and that's going to give us a 52 pip move. Price properly running up to this target, back down to the low, it gives us a possibility of a, is that 80 pip move. So you can see the way that having a daily target allows you to get ultimately a selection of points that you could possibly sell down from across a longer term bias. Now, if we just see price go lower, that's fine. Unless you're working on a lower time frame basis within here, you're not going to capitalize on that move. But we have multiple pairs sitting over here that we could see a similar thing happen on. Now, I would like to say that most of the time, if you follow the daily bias, you are going to be correct in movement on the greater scale. It does not mean that your entry will be correct. And this is something as well that I really like to emphasize, and everyone that's part of the PSS community and the Discord and on the YouTube, you guys know that statistically you have to be able to lose to be able to win. It's kind of like a casino. A great example is the Monte Carlo casino. The Monte Carlo casino once had a streak on the roulette wheel of, I believe, I might be incorrect here, 64 times it landed on black. And all of the people that were in, all the gamblers, all of the punters in the casino were ploughing their money into price landing on red, because it has to happen, right? You lose, you lose, you lose, you lose, you lose, you have to win. But that's not how probability works. It's not how probability works. And everyone was dumping their money onto red coming up, and it just kept landing on black, and it was the record profit taking for that casino, because they made so much money on everybody willing red to land when it ultimately just kept landing on black. Now, of course, this is very unlikely. Like the percentage of this happening is so low. But when it comes to following a statistical basis and a statistical understanding, just because you take one losing trade, that does not determine the next trade. And just because you take a winning trade, that does not determine the next. So the reference to the Monte Carlo thing is you have to be able to understand that losses are going to happen for you to be able to win. But what you don't do is change your actions and consistently pick to do something differently because of a previous result. So gamblers were betting on red because black came up so many times before, when in reality they could have just said, I'm going to randomly pick red or black each time, and they actually might have came out on top if they got black more than once. But it's less than 50%, so you're always going to lose on a roulette wheel. You can get big wins, but the probability is so small. The difference in trading is you only have two directions. It is literally a 50-50 chance that you will win. There is only two directions. If price goes sideways when you get into a trade, that doesn't mean that you lose. This is why Institute has such an easy time doing this, because they only have to pick one direction, and if it even slightly comes back in their direction, they can leverage that and get out with a minor profit or a minor loss. When you put a hard stop on things, that's when you begin to see the probability change, and it drops below 50%, because what's happening is price could move down, but it's going to hit a level that you don't want it to hit first. So you're wagering your knowledge of levels being hit, positions being held, and targets being hit. So it's like three different factors rather than just direction, which is a 50-50 bias. It really does start to change, the outlook of what's happening. So what we're looking for right now is price to come up and take out some of these points. Okay. Now the reason for this is because this might actually end up being invalid. We've got 2 minutes left on this candle. If this candle comes up above, this is no longer going to be a high. So why are we looking for this? Well, what this tells us is that Institute is accumulating points of liquidity that were pre-established in the market. If we see a gap occur to the upside, this also tells us that they are present in the upside, whether they're buying in to then sell at a better price, or whether they're selling off positions from better pricing. It's irrelevant what they're doing, but ultimately we need to see them coming in with the money to then leave with the money, right? So it only takes two clear points of reference for you to establish that, okay, our daily target may be the next area for this to begin to approach. Now, a very easy way of doing this is establish the basis here. So notice how we had, so we've got liquid high. We had a previous 15-minute liquid high. Well, that's actually the only one. This is a liquid high as well. This one right here. See, this is a liquid high because it swept out the previous high and then it came down and took out the low. Okay, so we know that this is a liquid high. So on the 15-minute, if you're using this on a lower time frame basis, you see the bearish shift here. If we see a bullish shift up to this high, then we break down again, you can begin to establish that there is high points of liquidity in here, and there may be an opportunity to sell lower. Now, the reason why it's not optimal to do this is because you will see the same signatures on a 15-minute for a move that goes like that you will on the higher time frames for a move that's going to run all the way down to the low. Now, the reason I say that is because if you're using the 15-minute as your point of reference, so let's say you're looking here to sell maybe down to here, that's great, but it's going to be a lot more, how would I say, harder on it's going to be a lot harder on your mindset to be able to actually jump in. What is that? I don't know what that is. Actually be able to jump in and out of these positions, which is, it's understandable. It's how things work. So you can see, again, liquid high, still the valid liquid high. So if price decides to come up to here, liquidate, then come down, you can there's an opportunity for you to short down there. Now, talking about the same thing, previously we took out this high, right? Look at what we did here. We went bullish, bullish, and then we created that bearish space. Price comes back to the point we created that bearish space from, and it sells. But it only goes down to a nearer point of liquid, which is the lows that we were talking about. So here, or here. They're both targets there. So you'd sell from here down to the low, but now price is coming back up again. So there is potential for the shorter term moves to happen, but it's always going to give you a stronger bias and a better basis to run off of if you're using higher time frame, because what's going to happen is if we do begin to interact with that, instead of it being a short 15-minute move that goes from here to here, it's going to be a bigger move that comes from here to your next hourly target, say. Not every time, again, this is a probability basis, so it's always going to have higher probability of price action actually fulfilling the longer term trend. So if you again chose to get down into lower time frames and do the same thing, you could. Okay? So the basis of where we are now, our hourly targets are still our 15-minute, and the 15-minute target lows would be here, so that would be a target low. Actually, I need to change these. These aren't liquid points. They are liquid points, sorry, but they're entry zones rather than targets. Target here, and target here. Now, why are we looking at targeting these? Well, one of them's a major structural low. One of them is responsible for sweeping previous lows within here, or a low, sorry. And then the other one is the nearest liquid low to the current movement. So we have 3 points to reference from. And then we have a point here to look at for possible validation of selling that lower. You can, of course, you can look at this point and this point and this point, but at that stage you just are going to end up highlighting every single low there is, and it's going to become a complete jumble of potential ideas. So until we expand to a clear point where it may be optimal for Institute to re-involve themselves for selling, or until we drop to a point where price may want to buy from, you're ultimately just going to wait for price action to deliver to a new space. Now, I've said before, you could run off of, let's go like here, you could run off of that sell move here. You could do bearish order block, for example. Run off the 50% of this and sell it from there, or you could run off the 50% of this and sell it from there, or 50% of this, sell it from there. There's going to be many points that you could sell off of. But realistically, Institute accumulate orders from the highs and lows of structural points. In the liquid that is left behind is left at highs and lows. So wait for those highs and lows to be interacted with, and then your move becomes a lot more probable, because you don't want to wait for 50% interactions on everything, because you could highlight every single thing and it give you an area to sell, or an area to sell, area to sell, and then it says, okay, cool, that's fine. And let's say price comes up like this, and it hits another area to sell. How many times you do that? Instead of waiting for price to interact, then give you a reason to actually sell it out, it begins to be a lot more systematic, a lot easier on you in terms of long-term analysis and principle, and it aligns with high time frame bias. It's just something that a lot of people struggle with. It's not your everyday thing. Most people want to turn up to the charts and go, okay, we've got a low, we've got a high. That means that this high and this high, this low, that means that we should long from here. Price is going bullish right now. We broke this, which means there is an order block in here that we could break down from, instead of just highlighting a clear point of high liquid and wait for Institute to take that liquid. You could always run between the two, completely fine. All depends how much work you want to put in, how much time you want to be adjusting your charts, how much time you want free off the charts while you wait for alerts to be hit. So yesterday there was a nice opportunity out of here. This is another example of the same thing. If you reduce these trades down to 1-to-1, that's a full TP. Reduce this down to 1-to-1, that's a full TP. Reduce this down to 1-to-1, that's a full TP. So instead of taking, reduce this down to 1-to-1, that's a full TP. So that's a 100% hit rate right there. But instead I took partials and BEs because of the longer term principle that I'm trying to sustain a system over possibilities rather than trying to sustain profits over short terms. Now, this is going to be completely down to how you want to trade, and there's nothing wrong with trading 1-to-1. There's nothing wrong with that at all. But you just have to maintain that overall percentage of wins. You have to maintain that win rate. So gold here, we're still looking for that shift down. On the 15-minute, you can see how this low is actually its own liquid low here. If we clear that, then this becomes a liquid high as well. So it would be entry to go long here, first target, second target, up, 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 up. Bias long on gold, by the way. So there's a lot of liquid sitting under here. We want a sweep down, reason to go long. Then we can start targeting the nearest structural point, the mid, the long term. And that's how you begin to expand up through the highs, if you're lucky enough to pick up the bottom end or something like that. Remember, this is the 15, so you can use the same principle. You could look at, let's say, okay, let's say we didn't have this. Let's say this structure here is invisible, okay? And you only have this to reference off, so we only have this to work off of, and that's your nearest liquid low, which it is, right? Let's say you come down to here. You could then reference off of the 1 minute down in this area and do the same thing. You could reference off of it and say, oh, we're just going to trade this from this point. Trade from here up to, let's say price does this. Like that. And then we get a change. You could trade up to here as your first target. Here is your second target. This is your long-term target. This is the closest point of liquidity. This is the last major high before we actually broke down into these major lows. And then we take out the high right here. And that'd be your final move. On a higher time frame, go to 15, that is all happening in the first move before you've even hit your first target. So it's always going to be down to your personal preference, how you want to manage it, how you want to trade the principle. So like here, this is a liquid low, didn't get hit. This is also a liquid low. That is technically a liquid low in terms of it didn't break any structure. So you could use the same principle here. If you didn't have higher time frame targets to look at, you would begin to look at this, see the gap present, and say to yourself, okay, cool, I'm going to trade off the basis that there is orders in here. I'm going to go long above these highs because I know price is more likely to go bullish. This is not something that I would recommend because, like I say, you have to have a much greater understanding of the smaller time frame to be able to consistently do that. It doesn't mean that you can't do it, and there's opportunity to get in long from here to go high. Yeah, great. But the idea is these areas are going to fail more times than the higher time frames because you're using a subset of smaller movements. Now, It doesn't mean that you can't do it. You know, it's completely possible to do this. I'm not saying that you can't. But let's be realistic. 95% of people that come from your everyday 9 to 5 background don't have time to consistently study the smaller time frame to a point where you can just walk up to it, trade it, and walk away. Doesn't mean that you can't, but most people don't have the time to do it. Okay, guys, so if you are watching right now and you're not already a member of the Discord, then the link is in the description for the Discord if you want to join. Lots of like-minded traders and lots of free content in there as well. If trading is something you enjoy but you don't have time to trade, then look into our partners, NestHab Investment. They will just make the money for you and you take your cut every single month. You don't pay a penny unless they make profit for you. And of course, if you are looking to fund your own private account, then you can look at our validated broker as well down in the description. So every link that is in the description we trust explicitly. I wouldn't promote anything that I don't trust. Of course, if you do want more information on anything, you can reach out to me privately in the Discord community, or just leave me a comment on the not Discord, on the YouTube video, and I'll get back to you. Remember, the same principle applies. This and this would be your target. This was the point you'd be looking for price action to run from. Price tapped in, you see a clear institutional involvement from that gap. Price delivers higher. So right now, if you're using the same principle that I said earlier, where you reduce your risk to reward down to a lot lower set, you'd be in and out of this already, adding to that statistical win rate, if you were. We're running off a higher time frame basis, so at the moment we're not trying to capitalize on those tiny little moves. We're trying to capitalize on the larger shift in market structure, which 90% of the time will only come once major points of liquid have been swept. I mean, this is a great example here. Look at the way this moves, right? Puts in a new high, major low, takes it out, goes long. Okay, price puts in a new high. In this case, this is the major low, nothing happens. Okay, cool. Price puts in a new high, major low, sweeps it out, goes long. Follow it up. Price puts in a new high after that high, major low, sweeps it out, goes long. Only goes long for a short period. Then we have another low, another low, another low. Price comes back down, takes it out, goes long. Same principle here. Price puts in a new high, follow it back. Where's a major low? Here, here, and here. Price sweeps it out, goes long. Right? How many times does that happen until you realize that actually trading within a structural perimeter is less probable than it is trading off of something that extrudes from a perimeter of that structure? And then you'll notice something as well. Not always, but a lot of the time when price action is moving against higher time frame bias, highs, that's swept, but most highs will remain unswept within here because it allows positions to be accumulated across them. So when price does come down and go higher, it ultimately leaves more liquid on the table to be absorbed. Then the same thing's happening here, right? So after this move, we were going lower, lower, lower. We sweep a low out, which you can see here on the higher time frame, but at the time you wouldn't know. And then price goes long, right? So we establish a new high. Then we have liquid low, liquid low, liquid low, liquid low. Price sweeps it, goes high. Sweeps that, goes high. Sweeps this, goes high. We sweep this, we're more likely going to go high. It's just a key principle that comes with your daily biases up. Your hourly structures are showing you the signature for liquidity. Exactly the same with the basis here on Euro. Our bias when we were going long, so over here, we were long. Look at the way price establishes a pretty similar principle. It puts in lows. So, for example, we'll go over here. Excuse me. This is the beginning of September. So we'll go over here, and you'll see that price action will go high, put a new high. Got a low there that doesn't get swept. That's fine. Price goes up, puts in a new high. It comes back down, takes some short-term lows, goes high. Same thing happens here. Puts in a new high. Look at the low. Low gets taken out. Go long. Same thing happens pretty much consistently all the time. The only difference is the way price interacts and moves with certain points is going to be different. So here, price goes long. We have a fundamental move come in. Highs remain. We take out higher time frame low. Go high. Put in a new high. There's no lows to be taken. Until what? We put in this low, establish a new high. Price takes it, goes long. Put in a high, low, low. Price takes it, goes long. It's always happening to the higher time frames. It happens to the lower time frames, but it's just going to be less consistent in the way that it plays. And that's why now our bias is short. Look at what we're starting to do here. So actually, let me see. Wednesday, 10 a.m. So we haven't actually done it yet. But in here, this was the first high that we took, and then we went short. So the same principle did not occur in this lower area. I mean, we did have a sweep here before we went low, but these are minor structures. So we're looking for that same thing to happen. We're looking for that sweep to go short, or the sweep to go short. It's more probable for this to occur. And at the time, in here, you can see that we sweep and go long, and sweep and go long, sweep and go long. At the time, our bias was bullish here. So the same thing occurs within the lower time frames and the higher time frames simultaneously. So it's just going to be down to what you decide to pick for your entry area. So if we go back to the 1 minute here, or sorry, was it gold? Yeah. So notice the same thing here that we were saying earlier. We want price action to go to lower points of liquid because they hold more value. So trading off of this principle, you could have got in and out here. Cool. Amazing. Now price is melting again because we know that this is a valuable point, or these two are valuable points, and this is a valuable point. So we're expecting that to then accumulate liquid across the highs to then trade with the bigger shift rather than trying to trade the smaller time frame. And so we'll go back to the hourly. You'll see. Notice what we've done here. The same thing. We've swept out a low, we've gone high. We sweep out this low, we're looking for that high. It's very simple, you know, there's not really a huge amount of context needed. You just need to look for where is the money sitting, where are the retail traders going to be closing positions in a loss, and where are institute going to be picking up their positions with a win. The main thing, like I said before, was like I spoke about in the Discord live stream, which was Bitcoin. Think about Bitcoin, right? They hyped Bitcoin through the roof. It was all over the news, you know, Bitcoin hitting new highs and people are making millions. And everyone bought in at the highest fucking point. People were buying in like 65k, 60k, you know, back when it spiked the first time round. Everyone was like, oh, you need to jump on Bitcoin. It's going to 100 grand. It's going to 100 grand. And then what happened? Inevitably, it dumped, causing some people to lose their life savings. Some people just lost chump change. But what happened when all those people lost? Well, the Institute bought it up like it was going out of fashion. The Institute bought the shit out of it. And this is why I believe that was one of the first public sort of very publicized, because people don't really look at it like this, but very publicized way of accumulating liquidity or accumulating an asset, when at the time, imagine if every single person that bought a substantial amount of Bitcoin had just held at that high and been able to keep losing money against it. Most of the Bitcoin would be in public hands, but now most of the Bitcoin is in institutional hands. We know this, they're openly public with this, but would it have been different if they hadn't have publicly told everybody to buy, you see it all over the news. When have there ever been any kind of asset, that's going high, it's making people loads of money? When has that ever been on the news? Never. So is there a reason for that? Realistically, we don't know. But the principle is there that I'm explaining to you. Everybody got out of their positions when the market was dumping, after they pretty much told everyone that it's going up and you should buy it. And then what happened? It went back up. Why did it go back up? Well, everybody that got their money taken out of their hands placed it into the hands of institutes. It's the same principle. What's going on, Shanghai? Love your live vids. Appreciate it, man. Too bad I have to work around this time. Yeah, I'm sorry, dude. I'm sorry. You can always watch them back in live stream. In replay. That's one of the benefits, I suppose. But we are going to be fluctuating the times. Sometimes we're going to do it like 10:30. Sometimes we're going to do it 12:30. Sometimes we'll do it at 3 in the afternoon. It's really just dependent on what I'm doing during the day. Like today, I'm going with my partner to a comedy show in London. We're going to go out and get some food beforehand. Should be awesome. Paul Smith, if anyone knows Paul Smith, we're going to go watch him at the OVO Wembley Arena, so it should be cool. But we're leaving at like 1:30, so we can get up to London and park and get some food. So I'm doing it a bit earlier today. But I appreciate the love. I'm glad that you enjoy the live streams. I'm glad you do. Okay, so that low was taken out. Still got a fair amount of liquid sitting across the lows. Remember, we're not too bothered about trading these lower time frames here. You can. It's not like you can't do it, but personally, I'm not massively interested in it at the moment. And this is another great example here as well. You can use the same principle, right? Sweeping out a low, which we know this is a liquid low because it's a downtrending move. We then come above the highs that take it out. And then if you look at the institutional move, the down FVG to the up move, that tells you institute is most likely seeking new highs. And lo and behold, the highs get taken. So if you just tried to trade from something within here, like a liquid point, up to the nearest high, you would have been able to capitalize on that, right? The same thing happens on the down move, but often the highs remain because it's not something they're looking to sustain long term. Let's go down and see if there's something here on the 1 minute. Nah, there's nothing you could really play off with in there. I mean, you could use order blocks, etc., but 100%. Yeah, appreciate it, Shanghai. Thanks for joining, even if you are at work. I appreciate the love. The live streams are just here for everyone to benefit from, and hopefully people get some value from them. That's the main thing. Okay, so we are looking for around another 5 to 10 minutes, and then we're probably going to wrap things up. I need to sort myself out before I leave. Need to get changed and all that good stuff, and make sure I do everything that I need to do, especially the report for our partners, NESAB Investments. I do the reports for them on a daily basis. Fundamental reports, understanding of key fundamental effects. All of the boring stuff that most people don't want to deal with. So remember, guys, if you haven't already, hit that like button and subscribe if you want to be a part of future uploads. So currently we're not seeing a huge amount. We haven't been on live for that long, so we're not expecting anything crazy. Let's go to the daily here with NAS 100. Close the daily gap, so we're still bullish on our bias for longer term movement. We come up above these highs, and price action interacted with this area of supply. Like I say, if you want to know why this is an area of supply, or why is this the only area of supply that's highlighted, head over to the Keep It Simple video series and watch those. Part 5 of those is coming out this week. I was going to release it yesterday, but I just didn't find time to do it. It takes so much time to edit and make all the adjustments, etc. I'm just going to delete a load of this. We don't need half that stuff in there. Okay, so that is a liquid high. That is also a liquid high. That's a low, liquid low, and liquid low. So we have our targets here. Sorry, not our targets, our points of interest here. Target being here and here, and here. We're just looking for an interaction with something lower. Go to the 15. You can see the same principle here. Look, reduce that down to a 1-to-1. What? Yeah, 1-to-1. TP straight out. Same here, reduce that down to a 1-to-1. TP straight out. So it's going to look good when you see a high hit rate, but it doesn't mean that the risk reward's great. And then if it is a high hit rate, high risk reward, it's generally high risk. There's risk in all trading, so it's, not the biggest deal in the world. Okay, so that was taken out. That's a high. It's also the 15-minute. This is a liquid point. That's the other point there. So we've got this, this, and this as our entry points. This is a short-term target. Longer-term targets are up above. Expect price action to do something like this. Or just that. Remember, you don't have to get this portion. This portion is only given if the market is willing to deliver to those points. Okay, guys, so I think gold heading down for a possible reversal if we sweep. Yes, this is exactly what I'm looking for. So notice the same thing here. This is what I was saying before. Notice how we've had the same thing every time. You sweep a major low, you go high. You sweep a major low, you go high. You sweep a major low, you started pushing high immediately. Doesn't mean you see a long-term you don't see this move sustained long-term, but that's because the higher time frame, which is the larger view of the orders, is telling you that there is potential for it to want to mitigate points that have higher values within them. If you're scalping this, you could look on the lower time frame, well, not lower, but you could look even lower if you wanted. This is the 1 minute, and you could ultimately scalp from this point to this point, 1-to-1, stop below the low, up to the high, push, in and out. Same here. Stop below the low, 1-to-1, in and out. There's always going to be potential for you to do that. Doesn't mean that we should do it. Quick money is not always good money. If we open up a space, which looks like we very may well open up a space, then that means longer term moves could occur. Target, target, target. So you begin to see that potential for that that move. We've taken out 2 lows, we've swept this, we're breaking structure that caused that sweep. It gives us a lot more potential to see that push up through the highs. So watch that high. It's a euro coming up towards these areas. GU is just dumping. Remember, don't be affected by the short-term movements. Short-term movements do not determine longer-term trends. That's just not the way it works. AU broke down pretty consistently across here. This was when we was going long, our bias was long, and we had that fundamental news come in. I can't remember what news event it was, but it came in fundamentally strong for the US dollar, so it pushed everything down. Our bias has since changed. We go to the daily time frame. Oh, actually, no, it hasn't changed on AU. That's fine. And here. See what's euro, gold. GU is just on an absolute plummet right there. See what triggered that. Is there something that's triggered that? Libya to resume oil production today. Oh, it's the UK PMI. That's what caused that. That's dropped off. Cool. Right. Get back to gold here. Okay, so we are going to go for a couple more minutes and then we're going to wrap things up. Remember guys, if you haven't already, drop me a little follow, TradingView, every Sunday, once this decides to load. Every Sunday I post a markup with an idea of what I'm looking at for the week. Always really simple, always with an institutional basis. You know, we're always looking at the same thing. Euro and gold, and you see like just from here, yeah, I said it's going to sell away from this high, or possibly could sell away from this high, and it sold away really nicely. So it's not going to give you trade setups necessarily, but it will give you context as to what you expect. So from here, for example, we had one area that we were looking for buys from, possibly. Price tapped into it, bought beautifully, hit the target that we had, then sold away. The same with gold. You know, we've generally been hitting gold pretty consistently. And like here, see how it came down. We didn't actually play. Well, we didn't actually give that as a play. So I'm not going to try and call that. But we have this trajectory line here, which isn't a trend line. Similar thing. We play lower, come back. Now we're starting to look for it to play off of this lower area. Our bias is still bullish though. There was, well, I mean, there's so many. You can look back. I think I've posted 290 ideas. So, you know, plenty of ideas for you to go back and look at. Plenty of ideas. Okay, so price pushing up now into these areas. Everyone's getting excited, thinking it's going long. We get ready to sell. Let's have a look at sentiment. Right, so at the moment, 78% of retail are buying euro, when our bias is short. So we're completely against the grain in terms of retail. Okay guys, right. Mark up your areas. Check the video that we've already uploaded, so this live stream. Rewind it, have a look, mark it on your charts. Take note of these areas and see if something plays out from it. If it does, of course, share it in the Discord and all that good stuff. If you don't want to trade yourself and you just want to make money, then check out our investment partners, Neshab Investment. They are amazing. And yeah, apart from that, guys, I will see you all in tomorrow's live stream. Hope you have a great day. Enjoy the rest of your week, and peace and love. I'll catch you all in the next one.